Hi guys, I'm Nicola McKenzie, founder, mortgage and insurance specialist here at DM Mortgages. And in today's video, I'll be bringing you a property and mortgage question and answer session. So to find out more, stay tuned. Now, before we get into the detail of today's video, if you haven't already, make sure that you hit the subscribe button and the little bell next to it so that you never miss any future uploads. And I also want you to consider using DM Mortgages when it comes to mortgage or remortgage on your next property. So head over to our website, which is dm.mortgage, and there you can book in for a free video appointment with a fully qualified member of our mortgage advice team. But for today's video, let's get straight into the Q&A, guys, because it's been months since I've done one of these. You'll probably remember, if you're a regular subscriber, that I used to do them fairly regularly, but things have been so busy with you guys contacting us to help with your mortgages that it's been difficult to find the time. But yeah, I thought I'd come back with a Q&A. So let's get into it. First question: what are the issues surrounding getting a mortgage on a non-standard construction property? Well, first of all, let's start by breaking down what non-standard construction actually means, because some of you out there may not know this. Standard construction, probably an easy way to explain it, is where the property is built from brick or stone and the roof is made of slate or tile. If a property falls outside of that description, then it's referred to as non-standard construction. Now, that can affect you getting a mortgage in a variety of different ways, and some of those ways can include the lender that you choose. So depending on what type of construction it is, because again, non-standard construction, there's lots of different types of non-standard construction. So it's important to find out exactly what type of construction the property is, and then it needs to fit into that particular lender's criteria. So some lenders will have a specific criteria on specific construction types. Other lenders might say it's subject to the valuer's comments. So when the valuer goes out and inspects the property, it's down to them in terms of what they think of how the construction might affect the property's future value. So you just need to be mindful and make sure that you speak to us and tell us as much as you can about the construction of the property when you get to the point of booking an appointment. And there we can guide you and fit you with the right lender. Now, it's also worth mentioning that depending on the construction type and how quirky the construction is, the quirkier it is, the more trickier it can get to place it with a lender. It might be that you have to go down a specialist lender route, or it could be that the lender requires a higher deposit because they see the property as higher risk. So I hope that answers that question. Next question: would student loan payments affect the amount of money that you can borrow on a mortgage? I'm paying roughly around £200 to £250 every month. So the short answer to that is it possibly can. Now, a student loan is no different to any other debt in many ways, in that when you apply for a mortgage, if it's showing on your payslip as a deduction, lenders will usually expect you to declare it as a liability. Now, how this affects how much you can borrow is going to depend on lots of factors. So what does your overall situation look like? How many other debts do you have? What other committed expenditure do you have? How much are you looking to borrow? All of these things will go into determining whether or not the student loan will affect you, because sometimes, depending on what your income is and depending on what other debts and commitments you've got, when we run affordability calculators, a student loan payment sometimes has no bearing at all, but it just depends on the individual circumstances. So it can affect it, but as to how much by and whether or not it even will, you need to speak to us and check in and get a proper affordability assessment done, is what I would say. As a viewer of this channel, I assume that you're considering purchasing a property in the near future. So it's important for you to know that DM Mortgages are an award-winning team of fully qualified mortgage brokers that provide advice to clients all over the UK. Now, we spend countless hours making free content for YouTube and other social media platforms to help to give you guys sound and useful information to make sure that you're in the best position to make informed decisions. To support this channel when the time comes for you to consider your mortgage options, we want you to book a free online mortgage appointment with a member of our fully qualified mortgage advice team. Because without your help and support, keeping this channel going simply isn't possible. Now, we searched thousands of mortgage products from high street and specialist lenders to find the right deal for your circumstances. And we also provide a free will writing service to every DM client. So head over to dm.mortgage and book in for a free mortgage appointment when the time comes. And also make sure that you subscribe to this channel if you find the content useful. But for now, let's get back to the video. Next question, can you get a buy-to-let mortgage to rent out a second flat if you are currently a first-time buyer mortgage, currently have a first-time buyer mortgage ongoing on a property you're currently living in? So yeah, I mean, I think a first-time buyer mortgage, I'm assuming that you mean that you just got a mortgage with a traditional lender as a first-time buyer, in which case then absolutely, you know, if the figures stack up, you're passing affordability assessments, then it is possible to take out a second buy-to-let mortgage and rent that out. That is something that's possible. Of course, whether or not you're eligible, individual circumstances, so get in touch. Next question is from Julie Lamb 2884, and Julie wants to know if the builder says the contract exchange date, so I'm presuming that you're buying a new build property, the contract exchange date is confirmed as the 15th of August, but my solicitor, recommended by the builder, is slow and unlikely to meet the 15th of August, do I still need to comply with paying the 10% deposit before the 15th of August? Usually the deposit is going to be due on or close to that exchange date, Julie. So I'd probably say it depends on, you know, if they're not looking likely to meet that 15th of August deadline exchange date, you know, if they're looking at doing it the following day, then you're still going to need to hand over your deposit, you know, probably the day before, as an example. But it just depends on how delayed they're going to be after the 15th of August. But, you know, they're not going to ask you to send the deposit over usually 2 weeks in advance, as a hypothetical example. So you send your deposit pretty much right close to the exchange date, whenever that is. The next question is from M Palmer 7129, who asks, does a let to buy mortgage allow you to raise up to 75% of the current value of the property, or only against the existing equity within it? So you've even given an example. If my new home is now valued at 500k with only 100k left to pay off my mortgage, would I be able to raise up to 375k or 300k? Okay, I see where you're going with this. So potentially you could raise up to 375k, but you'd then need to deduct 100k from that to repay your existing mortgage, and then you would keep the difference potentially of 275k. Okay, so I hope that answers that question. Obviously, whether or not you can go up to 375k, subject to normal affordability rules. With that said though, let to buy affordability is largely based on the future rental value as well. That's a large consideration when lenders are looking at giving you a let to buy mortgage. Okay, next question. If you've saved for your lifetime ISA for 3 years, will your bank or mortgage provider have to go through 36 months of bank statements, pay slips and financial record checks before approving your mortgage application? Or will they go through 6 months, or will they go through 3 months? Quite a few options there. Well, it depends what you do for a living. So if you're self-employed, they'll want to usually see the last 2 to 3 years, yes. If you are employed, then usually they'll want to see 3 months pay slips, even if you've been saving into your lifetime ISA for 3 years. If you're referring to proof of your deposit, then typically speaking, again, it's going to depend on the lender. The lender may not actually ask to see the deposit or statement for the proof of deposit at all. They might ask for the most recent bank statement. It does just vary. So yeah, I hope that answers that question. I hope that's been useful, guys. Now, can I ask you to keep dropping questions in the comment section, because if you don't ask me questions, then I find it difficult to do these Q&A sessions. It's taken a while to bring you this most recent one. I will try and post more regularly in terms of Q&A sessions, because people do comment and say that they're useful. I tend to try and cover a variety of questions. So drop more questions. I'll look forward to catching up with you in my next video. Head over to our website if you do want to look at your mortgage options, which is dm.mortgage. Hit the subscribe button if you haven't already, and I'll look forward to seeing you in the next video.